Hey, how you doing? Seth Barquette here with Green Key Mortgage. I want to talk a little about mortgage insurance. Who doesn't love mortgage insurance? The less you pay mortgage insurance, the better. And UWM is probably the biggest wholesale lender in the country. Claims they have the lowest mortgage insurance. If you do a comparison with, your Genworths and your MGICs, you'll find that their coverage is lower. And, because they do so much business, they are able to offer a little bit lower rate, which is great because MA is not tax deductible unless you're making, I think, under 100 grand. You cannot deduct the monthly mortgage insurance like you can interest on your mortgage. Even if maybe you're paying a little bit higher rate, but you have a lower mortgage insurance, it might be better in some cases because you're able to write off the mortgage interest but not mortgage insurance. That being said, we'll take a look at it. This is a UWM's rate sheet on borrower paid MI over 20 years, meaning basically a 30-year mortgage. As you can see, the higher the LTV, the higher required coverage. And we'll take a look at it. Let's say 80 to 90% with a 740 FICO, $500,000 loan amount. We'll do that comparison with those other MI companies. And you're probably wondering why we have two different brackets here on this rate sheet. And those lower brackets are for the Home Ready and Home Possible programs offered by Fannie and Freddie. We talked a little bit about those last week and the advantages of those over your typical FHA loan. And also, if you scroll down here, there are hits. If you're doing a second home, there's a hit for that, or multiple units, cash out, or investment. So you got to do the math if you're doing one of those. We'll go take a look at these other companies and see what they're offering in that same scenario. Here's MGIC's rate card, and going down here, got 90%, which we're talking about here, 25% coverage, 740 FICO. Their rate is a little bit higher. It's 0.38. So, that being said, they also have more hits than UWM does. They hit you for just about everything: cash out, second home, manufactured, lender paid. And they even hit you, if the DTI is a little bit higher, they're going to hit you quite a bit. Whereas I notice on UWM, they don't really have that hit. So, in some cases, it can be even a bigger advantage depending on the particular scenario. And also, with multiple borrowers, you get a little bit better rate depending on the situation. Whereas UWM does not have that price reduction. They just give you the lower rate based on multiple borrowers. The difference, you get a 0.07 better in rate. So if you have multiple borrowers, it seems like it almost works out to be the same from UWM 0.3 to that same scenario with MGIC at 0.38. But let's say you have two borrowers at 90%. We're going to get a break here. Where is 740 there? We're going to get a break here of 0.07. So that would then take us to 0.31. So then, there's really not a big difference. So I guess it depends really on the scenario and whether or not it makes sense. We'll take a look at Genworth here. They have a cool little express rate comparison here. You just punch in the details of our transaction. We'll do that right now. $500,000 loan. Talked about going to 90%. Do 740 FICO. Let's go 45 DTI. Let's start with one borrower. Talked about there was a hit for just one borrower. It's better for two, I should say. And we'll do a test case. Select the states. Purpose of the loan: purchase. Do borrower paid MI is what we talked about. No deferred. Single family, fixed. 25% coverage is what we're looking for. We're not using a home affordable program on this one. 30-year fixed, renewal option, constant primary residence, and let's say we got to approve eligible on our DO run. It's not a relocation program. And we'll run that real quick. And they too have that 3.8 rate. So the 3.8 rate again, is higher than what UWM offers, but let's go back and edit this quote. What if we do have two borrowers? Does that change anything? Like it does over at MGIC, where they have that break 0.7. Let's go ahead and we'll run it again. And then sure enough, it brings it down to 0.31. So, my conclusion is, the rates are, you can get better rates at UWM, but it really depends on the scenario. One quick thing I want to show you here on Genworth, though, is it's kind of cool. You can compare it with another program. Do borrower paid, and then a single payment, meaning you pay upfront the mortgage insurance. So you can buy out the mortgage insurance up front, so you don't have a monthly premium at all. And we'll just compare that quote. This is something that I don't often sell. Maybe we should do that and consider that more often. For example, this scenario we're talking about, the $500,000 loan amount purchase, 10% down, the upfront mortgage insurance can be bought out for $5,300. I think it'd be helpful if you had additional, let's say, seller contributions, or you have more lender credit than you know what to do with. I mean, you could apply it to the single pay upfront mortgage insurance premium, and just buy out the mortgage insurance. To me, that'd be really helpful, and I'd probably consider doing that at this point if I was just putting down 10%. It seems like it pays itself off rather quickly. So if we have a monthly MI of $129, let's take a look at that. So let's divide the cost to buy it out by the monthly to determine how quickly it pays itself back. So if you have $5,300 to buy it out, divide that by the monthly cost, pays itself back in 41 months. So 41 months divided by 12, that's 3 years. Just over 3 years. I mean, that to me, that makes a lot of sense. Hopefully I'm doing that right. If I'm not, let me know in the comments below. But I think that's a pretty cool program. I'm going to start considering moving forward. So going back, when does it make sense? I guess certain scenarios it would make sense. If you have a DTI over 45%, then there's another hit that I don't think UWM has. Our start rate is 3.8. If you have a client that, let's say, is single and has a DTI over 45%, then we're looking at an additional hit of 0.12, and then you're talking about an MI of 0.5, which is a lot more than UWM. So it really depends on the scenario, I guess. So then you're talking about 500,000 times 0.5%. That's $2,500 annually that they would save with the UWM product. So if you have somebody, who has a higher DTI and a single borrower, not joint borrower, the MI gets considerably more than UWM, because UWM doesn't have the DTI hit. They don't have the multi-borrower discount though. So the exact same scenario with one borrower and a higher DTI, the MI rate goes to 0.48, and UWM's just stays the same at 0.3. So the difference between those two is then a little more significant. Let's calculate it real quick. Break out our calculator. So on a $500,000 loan amount times 0.48%, looking at $2,400 a year. And we'll take $2,400 and divide that by 12. That's $200 a month mortgage insurance. And what would we say UWM was at? UWM 500,000 times their 0.3% is 1,500 a year. That 1,500 divided by 12 is $125. So now we're talking about more like a $70 savings when you compare Genworth and GMAC to UWM. So it really depends on the scenario and whether or not it makes sense and how big of a benefit it is using UWM compared to some of the other MI rate companies. So I hope this helps everyone out. Another thing just to reiterate that upfront single payment MI might be a good thing to look into, and I'm going to do a little bit more of that and maybe get back to you at a future who's offering it and whether or not it's something that you want to start offering. So that same scenario obviously was a little higher rate. Now you can see the upfront rate went up too. The initial upfront buyout rate went up quite a bit when you had the higher DTI and the single borrower. So, it's something to consider. Nowadays, you want to save your clients as much as possible with rates going up, and you want to find as much benefit as you can in your sales pitch.